To the markets now, and a flurry of results landed on what proved to be a downbeat day. The ASX started well as the results came thick and fast, but was soon out of puff and heading the other way, closing down more than 1%. QBE got a tick for upping profits and its dividend. Challenger too, after an increase in funds under management. Dick Smith got smacked though, despite a third year of sales and profit growth. Qantas will net a $210 million from the sale of its terminal lease back to Sydney Airport. Qantas results due on Thursday, by the way. And CBA was the biggest loser among the banks after going ex-dividend today. Across Asia, shares in Shanghai fell 5% with a late afternoon sell-off. Tokyo and Hong Kong slipped. And the Australian dollar's down against all the major currencies. And Roger Montgomery from Montgomery Investment Management is with me in the studio. Roger, results so far. Let's go to Asciano first. Up 40% its profit, but overwhelmed by this big takeover bid from Brookfield Infrastructure.
Yes, and in short, shareholders should welcome the bid with open arms because it's way overvalued. Clearly, Brookfield think this is the end of the global trade slump. But as we've discussed previously, China's problems are only just beginning. And I think, as we've seen with the results of ArcelorMittal, the results of Vale, things are only going to get worse before they get better. So this is an opportune time for shareholders to take a bid from an optimist.
Well, do you think now that, of course, Brookfield, I think they've got rail in WA, they've got Queensland's Dalrymple Bay coal terminal.
Yes.
Now that's presumably going to be a stronger competitor for Horizon, which was the other company that had results this week. Now they are guaranteeing a 70% dividend payout or greater over the next 3 years, Horizon.
Well, that's curious to me because this is a business whose revenue has declined by about 3%, and that's the result of a 15% drop in net tonne kilometres in the iron ore business. Now, the iron ore transport business is about $380 million, whereas their coal business is about $1.8 billion, and that only fell by 1%, the net tonne kilometres. So we're only just seeing the start of the problem in coal. We've seen a large problem already in iron ore, and that's only had a modest impact on the revenue of this company. But when the coal problem starts for Australia, and it will soon. We've already seen, for example, Alpha Natural Resources in the United States and Walter Coal file for Chapter 11 bankruptcy. This is a result, of course, of China's steel demand declining. Then I think this company is going to be in a lot of trouble. Now, a payout ratio of 70% is one thing. It doesn't mean that your earnings are going to stay where they are.
Yeah, I was going to say, presumably the guys running Horizon know about their coal forecasts, but they've got this cost-cutting program going on, and they were government-owned. Words like feather bedding come to mind. Certainly,
exactly.
Those were the reports. So is that where all the cash is actually going to come from costs cutting?
Well, I think it is, and that story hasn't finished yet. That cost out, what we call the cost out story, as a result of the transfer of the business from government hands to private hands, that's still ongoing. So while our thesis is very, very negative for Horizon, there's still an opportunity to get some costs out and make things look a little bit better.
All right. Banks. Investors seem to be sort of rather lost in the fog here. Will there be more capital raisings after these enormous deals to go to the market? They've been from several of these banks now, 3 I think of the big 4, and a DRP as well.
Yep.
So are we going to get more capital raising on top?
Don't think so.
You don't think so? Fitch has come out today suggesting it's not over yet?
Look, I disagree with Fitch, and I think that we're done, and I think the remainder of the capital that needs to be raised can be raised through DRPs and also through asset sales. So the bulk of the money that needed to be raised has been raised, but the outlook for banks' return on equity isn't going to get better. If anything, it's going to decline, and that's because mortgage risk weighting ratios have increased by 40%. That's reduced the leverage for mortgages that banks can apply by 40%. That's going to take a big hit, and then you add on the capital requirement, and so return on equity is going to take a hit. Valuations are going to take a hit.
So
precisely.
Dividends are going to keep coming then?
Well, I think the payout ratio will remain very high, but whether or not they can sustain growth that we've seen in the past of dividends, I doubt that very much. And remember, analysts, there's divergent expectations here. Analysts are not factoring in any increase really in bad or doubtful debts from mortgage defaults.
And moving to oil, Santos is another company that, well, it's saying it's not going to need to go to the markets for a capital raising. What's your take on that?
Well, the broader story for oil is, we think, lower prices for longer, and that's going to put Santos under enormous pressure. Maybe not as much as US producers, because obviously Santos's costs aren't in US dollars, but the reality is we're going to see the Saudis continue to ramp up production and put the unconventionals in the United States under pressure.
Yeah, are the unconventionals in the United States surviving though?
They are surviving. They're getting rid of a lot of costs, and that's surprising the Saudis.
Roger Montgomery, thank you very much for all that.
It's a pleasure, Ticky.